Today, there's no time to waste. All right, so good evening to you all. It's your tutor, Henry Breman. And as usual, you can call or WhatsApp me by 02435833352. Or you can email me via bremanhenry1@gmail.com. bremanhenry1@gmail.com. For some time now, we have been looking at the introduction phase of the financial management paper. I think that it's time for us to go deeper into it. Right. So if we look at part A, we'll be looking at issues pertaining to the environment for financial management. Then the next bit, we'll be looking at financing decision. Then from financing decisions, we'll be looking at issues pertaining to the time value of money. Talking about bits in the case of perpetuities, annuities. We'll be talking about all those bits in the case of time value of money. Then part D, we'll be looking at investment appraiser techniques. Over here, we'll be looking at issues of internal rate of return, NPV, payback period, discounted payback period. We'll be looking at those bits and pieces. Then finally, we'll settle on capital rationing, talking about issues of profitability in this. Then from there, we'll be looking at financial risk management. Over here, we'll be looking at the hedging techniques. We have two main types of hedging techniques. We have the currency hedging techniques, then we have interest rate hedging techniques. Currency hedging techniques and interest rate hedging techniques. So we'll be looking at those two bits under financial risk management. Then part F, we'll be looking at working capital management. Basically, when you talk about working capital management, both under financial management and financial reporting, when you talk about working capital management, you are talking about management of your inventory, management of account receivables, management of account payables. Three main items do we talk about as working capital management. We talk about accounts payable. We talk about accounts receivable. Those who still be looking at issues of financial reporting, cash flow statement, you still talk about working capital management. These are the main elements which can be categorized as working capital management. Accounts payable, how do we manage our accounts payables? How do you manage our account receivables, who are also debtors? How do we manage inventory, right? So these three bits are what we talk about as working capital management. So we'll be looking at calculations in the inventory. We'll be looking at issues pertaining to the economic order quantity calculation, those bits. Account receivable, we'll be looking at factoring. And we have two main types of factoring, recourse factoring, non-recourse factoring. Payables, we also be looking at issues pertaining to what's payable. Then the last bit we talk about under working capital management is issues pertaining to cash management. How are you managing your cash, right? And we'll be talking about bits in the case of the Miller-Orr model, Baumol model. These are issues that we'll be talking about under cash management. And finally, our very good friend, which we tend to cherish most, issues pertaining to business valuation, mergers and acquisitions. Business valuations, mergers and acquisitions. So we'll be looking at these elements for our meeting. That is exactly what we are going to focus on to ensure that we wrap up with bits in the case of what financial management. But meeting you today is to just introduce you to financial management. Meeting you today is to just introduce you to financial management. So I'd like to go further in the case of what I want to talk about. And the risk management, which turns out to be a challenge to a lot of students, we'll be looking at the role of the treasury management function, funding for long-term and short-term purposes, financial forecasting and planning, bank relationship and credit ratings, evaluation and management of risks and return, and the relationship to portfolios. Thereafter, we look at the overall heading of explanation of the environment in which the treasury management is practiced, looking a bit in the case of risk culture, values, financial objectives, organizations' risk profile, currency risk, interest rate risk, liquidity risk, and credit risk. Some types of what risks. Impact of market volatility, the bull and bear what markets, monitoring key financial market indices, and then we tend to look at practical examples in here. But what I tend to look at is that those bits we looked at from here, that is this side, are basically theoretical. There isn't any calculation over here. This is exactly where I want to talk about. Every bit in here are just what? Theoretical. No calculation over here. So we come to the most important bit where there's calculation. Some people do not look at it in that regard. They tend to still look at it in theoretical, but it's still important we look at calculation bit over here, right? Good. So explanation of transaction risks, economic risks, translation risks, we look at those bit. Then we now look at the hedging techniques itself. I've explained to you that we have two main types of hedging techniques. We have currency hedging techniques, then we have interest rate hedging technique, right? They are two different bits. If we're hedging based on currency techniques, it is different from hedging based on interest rate hedging technique. So we look at the hedging techniques in that regard and just keep you satisfied. Right. So we have some techniques that we tend to look at in hedging against an exposure. I will explain to you what we mean by exposure as we tend to look at the introductory stage of what this main topic, risk management. So we're talking about issues of what? Invoicing in local currency, leading and lagging, matching and netting. We have types of what? Netting, unilateral netting, multilateral netting. Then we come to issues of forward contracts, hedging using forward contracts, money market hedge, currency options, currency swap, currency futures. We're looking at these bits and pieces. And that will end issues pertaining to risk management. But as I've indicated, I will still walk you through a question just in case, in the case of calculation, right? In the case of calculation, so that it will help you, keep you satisfied, right? If the examiner is bringing any question in the case of risk management, you know for sure that the sort of training that we have given to you is more than 100% to keep you in good shape, just like students who sat for last certain exams. Then we now look at, so this bit will end for risk management. Look at the introductory phase, looking at the bits of still introductory in the case of theoretical, then calculation to end it all, right? Good. So we move on to the next area, which is working capital management. We have indicated that working capital management is one of the areas we tend to look at, but what are the bits and pieces under that we are going to look at? Explain the rules and objectives of working capital management, determine working capital needs, and funding using funding strategies such as aggressive strategy, right? Conservative and matching principles. Some students do not know the difference between an aggressive strategies of working capital management and that of conservative. We look at that, right? Then we look at management of inventory, as I've already indicated. When you talk about the cost of inventory, we look at basically the purchase cost, right? Look at the purchase cost. We look at cost of ordering, cost of ordering, cost of ordering. They look at cost of holding the inventory. This becomes the three main elements to consider over here. So you have the purchase cost, we have the cost of ordering, which is the ordering cost, and lastly, the cost of holding the inventory. Three main elements of cost under inventory management. Important technique to talk about is the just-in-time system, where little or no inventory is kept, and the determination of inventory to order using the economic order quantity formula, right? Management of account receivables, we'll be looking at the cost and benefits in giving out credit. We look at how to formulate credit policies for organizations, how to evaluate credit policies of organizations, and the use of early settlement discounts to boost sales. Management of trade payables, identify the problems of delaying payments. So if it happens that you have a creditor or supplier and you tend to delay payments, what are some of the issues which tends out to come up? And the use of early settlement discounts. to also manage what? Trade payables. Then we come to our last friend, very important, cash management, reasons for holding cash. Reasons for holding cash. So are we holding cash on the basis of a precautionary motive? Are we holding cash on the basis of a speculative motive? We look at all those bits and pieces. Explain centralization of cash management. Apply cash management models such as the Momo model, the Miller-Orr model, and cash budget. Cash budget tends out to be an issue which is mostly examined in the case of management accounting perspective. Management accounting and cash budget, just like last sitting, it featured in students who sat for the management accounting one paper, cash budget. It has been an area of importance for such a paper, right? Then the last bit is advising management on investing short term. It's good for you to invest long term, but sometimes it is important for you to also look at short term investment techniques or investment opportunities in that regard. So if I should take you back, we basically look at in detail risk management. So all bits and pieces over here talking about risk management nitty-gritties, which I've walked you through, right? Then we decided to come in here to look at working capital management, management of your inventory, management of your account payable, account receivable. Then we decided to add a bit of what? Cash management, cash management. So that is that side. Then the next page talks about business valuation, right? There are instances which trigger valuations of business, right? It can be that probably maybe an institutional shareholder or shareholder activist can call for valuation for the business, or in instances where there's going to be mergers and acquisitions, there's the need for us to look at business valuation. At the point where a company is going to liquidation, it is also important for us to determine the valuation of the business. So we have instances which will trigger, or conditions which will trigger the valuation of business. It will be insane for the financial manager to just wake up without any cost to just say that I'm determining the value of a business. That would be insane. But there are certain conditions which will trigger business valuation. And my meeting with you will not only be looking at passing the exams, but you need to be formidable such that, most importantly, wherever you tend to find yourself by work or whatever, these bits and pieces become very applicable. One information you should also know is that after you chattering, going through that, getting your membership, you also get opportunity to be placed on certain boards, either local assemblies and that sort of, and we want you to bring your experience to bear, right? Good. So although it's important to pass, which is the quest of every student, but I all the time tell you that passing, it turns out to be a short term, maybe just the maximum of 6 months, you tend to pass the exams. But whatever you tend to learn will be with you for the next 35 years or 45 years as you tend to work with. And passing is an important thing. Every individual will want to pass, but whatever will tend to be with you the long term is very, very important, right? I've audited clients where after having a discussion with the client, you realize that the main boss is not really competent, and the kids, or let me just say those assistants tend to laugh. So you might be happy on the basis of that you are passed, but if you are not really solid with whatever you learn, probably you might not know wherever your weaknesses will be shown, right? So in determining the valuations of business, we have techniques we tend to look at in the valuation of business. We have the asset-based technique, which is mostly looked at as asset stripping, and is mostly applicable if the company is in the liquidation stage, right? But one technique we tend to talk about in the case of, or one issue that we tend to talk about in the case of asset management is that it ignores intangibles. It ignores intangibles, which intangibles are also assets. But how do you determine the valuation of a business? By incorporating the intellectual property of management. It is not possible to do that. In the case of valuations of business, certain items like customer list, which turns out to be intangible item, cannot be factored into the valuation of the business, right? If somebody wants to buy a company, can we determine the intellectual property of the management of that company to be factored in for that acquirer to pay for it? It is never going to be possible in that regard. So this technique tends out to look at Instances where there's liquidation, we are looking at the physical asset, selling this physical asset to generate cash to pay off what creditors or to defray our debt. In that regard, we'll go into the nitty-gritties of those bits as we tend to move along. They will look at earnings-based technique. We also look at what PE ratio. Later on, you realize that the inverse of PE ratio, right? Later on, you realize, just keep calm. At the moment, if you do not know this bit, it's normal, right? Because we just started, and I'll give you all these hints. You know for sure that the inverse of earnings yield formula, right? The inverse of earnings yield formula will give you PE ratio, right? That is the reverse, right? So what am I trying to say over here? If PE ratio turns out to be, let's say, 5, and we ask you, what is earnings yield? What is earnings yield? You say that earnings yield is 1/5, and 1/5 will give you 20%, which is the same as 0.20. Right. He can also give you, let's say that the earnings yield this time around, the earnings yield has been given to you as, let's say, 4. And we ask you, now that earnings yield is 4, what is PE ratio? We ask you to determine the PE ratio. PE ratio becomes the inverse of the earnings yield. And so far as the earnings yield is 4, we say 1/4. And 1/4 will give us 25%, which is also equal to 0.25. Right. So we look at the use of PE ratio methodology in the valuation of a business. Then we look at the use of earnings yield in the valuation of a business. We look at market-based valuation techniques, such as the use of the free cash flow methodology in the valuation of a business. We look at those bits. Then I will introduce you to one beautiful technique by all standard, which we tend to look at in all our techniques of weighted average cost of capital. Here we look at dividend valuation model, the use of dividend in the valuation of a business. We talk about dividend policy a little bit, talk about the dividend signal theory, at least a few bits over here to keep you 100%. Market-based techniques, earnings-based, asset-based valuations in determination of what prices. We talk about all those bits. How to determine the market value of a company. We talk about all those bits. So market value of equity, you can calculate the market value of equity. You can determine the market value of company. Market value of equity will be the number of shares times the price per share. Right? So this is way of determining the market value of equity. Sorry if it sounds that I'm just bombarding you with all those bits. At the end of the day, you are going to be formidable and you can rattle this bit just like the same bit that I'm doing now. We'll also be looking at the explanation of the types of mergers. We have types of what? Mergers. We will look at identification and explanation of defensive techniques against takeover. If one company wants to acquire you and you do not agree for that takeover to happen, what are some of the defensive techniques? Some time back when we were kids, we used to play a game called Pac-Man. And Pac-Man is one of the techniques, defensive techniques, right? As you tend to acquire me, you come up with techniques to acquire me. I also come up with processes to acquire you. We tend to say that if you, let me see if I have any of the guys with me at the moment. I do not have any guy with me at the moment. But if you know for sure that your best friend or your friend is a womanizer, and it happens that you see that you want to make advances on your sister, what you have to do is that as he makes his advances, you also make your advances on his sister. That counter what bit, it is what we call the Pac-Man, and it's a technique. I've just explained it in practical terms, but that is the same bit which happens as a defensive mechanism to avoid a hostile takeover in that regard. So if one company wants to acquire you and you do not want the acquisition to go through, we have ways of coming out with certain strategies to prevent the acquisition from going through. And I will just walk you through that. We call them what? The defensive mechanisms to a takeover. Defensive mechanisms to a takeover. Then we come to the next, which is identify and explain advantages and disadvantages of mergers and acquisition. Advantages and disadvantages of what? Mergers and acquisition. Your examiner do not talk about types of growth, but he tends to examine types of growth. That is very sad that whatever you want us to look at, you do not talk about types of growth, but you still ask us questions on types of growth. But it's important we have seen that in that light, we tend towards factor those bits in analysis. So look at types of growth. We have two main types of growth. We have growth by organic, then we have growth by what? Acquisition. Growth by organic, growth by acquisition. Growth by organic, growth by acquisition. We talk about the nitty-gritty test in the case of advantage, disadvantage of growing by organic and growing by acquisition. Right. Just stay put, relax. I'll walk you through this bit and keep you satisfied. Next bit, explanation and application of financing methods for mergers and acquisition. Calculate cost and gains of mergers and acquisition. Now, one thing that I'll walk you through, which from my standpoint, it is going to be excellent, is that we are going to imagine that probably we have a particular company and we are shareholders, and we are going to go through the processes of acquiring that company. In that regard, how are we going to start it? What should be the first thing? What should be the second bit? What should be the third bit? What should be the last bit in that regard? These are the bits and pieces which makes the learning practical, not just theoretical. Some students tend to all the time be in the mood of what the theory bit, to write the exam, pass the exams, but that is not what I'm looking at. You need to be practical and you need to be formidable, such that after learning this bit, wherever you tend to be, the financial management paper will be in your blood. Then we tend to know that, yes, you have really learned something. Not on the basis of just going through past the paper, then it ends there. I do not see that as a good thing to do. Probably if a student is looking at that bit, I would advise you not to look at it only on the perspective of passing, instead passing and also becoming formidable with whatever you like. In the case of investment appraiser, there cannot be a financial management question without investment appraiser. I have not seen issues like that happening before. That a student says that I walked into the exams hall to write an exam in the case of financial management, and I didn't see a question under investment appraiser. That means that you have to be careful with that type of paper that you actually start. You have to probably turn to the face or the blurb and actually check if it is a financial management paper. It doesn't happen in that regard. That is basically what the sort of issue that we want to come across. Right? So we're looking at profit techniques. Right? Profit techniques. So over here, you realize that before we would tend to say that we are appraising an investment, right? We do not look at appraising investment once the project has started. Then why do you tend to look at that, right? It's just like the case of a lady who has given birth to, let's say, 4 kids with one particular man who turns out to be the husband. And after giving birth to the 4th kid, you are now trying to sit down to look at the behavior of that gentleman. It is insane to do that. Why do you have to go through the process of giving birth to 4 kids? They now tend to sit down to look at the type of person that person is, right? That is very bad. And that is to just let you know that we do not look at investment appraisal once the project has even started, not to even talk about getting to the middle or getting to the end. That would be insane to do. So we look at appraising the investment, look at the pros and cons to see whether it is good to go or not to go. Then if it's good to go beyond reasonable doubt, then we now have to look at the funds available. Then we now start the project in that regard. You do not get to the middle of the project. They now sit down to see, I want to appraise the investment. That is going to be insane in practice. And it turns out to be insane in every regard, which does not happen. Some student tends to ask beautiful questions in that regard. If we have not started or commenced the project, then those figures that we tend to get in questions or the financial manager will tend to use, where would we get that from? And the issue is that we get those figures from market survey. Whatever business you want to do, it might happen that you already have a particular company who is also in the same industry, like the industry you want to enter into, who is doing exactly the same bit like whatever you are doing. So you can inquire to know projections of cash flows, projections of cash outflows, and you can use that as your estimation. Do not forget that firms in the same industry have the same business risks, right? So we use that as our estimation, right? So we look at profit techniques. in investment appraiser, appraising the investment to know the in and out, right? And we know for sure that in practice, if you are a financial manager and you're going to defend, right, in a board meeting that an particular investment or project is viable, it makes economic sense, you will tend to have non-executive directors on the board who are waiting for you to pounce on you with what? Their questions, because non-executive directors are those directors who are well experienced and they are on the board basically to challenge the strategy of what executive directors. So we look at techniques such as profitability index. So look at techniques such as profitability index. Profitability index. Look at issues pertaining to accounting rate of return. Accounting rate of return. Accounting rate of return, which is called what? ARR. Right. Then we come to issues pertaining to free cash flows. So cash flow techniques. We know for sure that with profits, the accountant can manipulate profits, but with cash flows cannot be manipulated. If it's $5,000 you have received or 5,000 Ghana cedi you have received, you don't have two types of 5,000 Ghana cedi. So how can you manipulate that? So we look at issues of payback period. Here I'll explain to you how payback period came about, right? And what was the limitations of payback. And that's why the limitations of payback led us to adjusted payback. Adjusted payback. Adjusted payback is also called discounted payback. Right? Though looking at the limitations of payback period, which we thought that adjusted payback could solve the problem. We thought that adjusted payback could come in and solve the problem. They couldn't solve the problem. There came issues of what? Macaulay duration and modified duration, but they are not in your syllables to look at. So you should know the trend. What was the first technique which was invented? And why was it not good enough? That's why we invented something new. And what was the pros and cons in the case of all those techniques? What is the overall objective for that technique? Very, very important to look at. So we look at payback period, look at adjusted payback, which is also called discounted payback. We look at issues in the case of internal rate of return, IRR, which is also called, the examiner brought this bit in the case of last two sittings, and a lot of students were taken by surprise. They never knew that it's the same sort of name, which is also called the break-even rate. Break-even rate. Because we tend to define internal rate of return as the rate at which NPV is equal to 0. If NPV is equal to 0, then what are we trying to say? The total cash inflow is equal to the outflow. And in the situation where total inflow is equal to outflow is at the point where we are in the break-even state. So internal rate of return is also called break-even rate. It actually took a lot of students by surprise. 20 markup question, you couldn't get it done. That is your fault, right? Good. So we move on to C. The C aspect, we'll be looking at what? NPV. In theory, looking at all the investment appraisal technique, in theory, NPV is the best investment appraisal technique, right? Because it's directly linked with the shareholder weight maximization of the company. So we'll be looking a bit in the case of what? NPV. Looking a bit in the case of NPV. Now, one of the things that I would want to talk about after looking at issues in the case of investment appraiser, those techniques which comes up under investment appraiser, I would also be talking about other risk measures. Other risk measures. What are other risk measures? I'll be talking strictly issues about sensitivity analysis. So I explained to you sensitivity analysis. In practice, how do we apply sensitivity analysis? Not just a matter of learning it and being a champion that you have learned financial management, you have heard about sensitivity analysis. We give you an Excel sheet, come up with sensitivity analysis in the case of particular bid, and you do not know. Then what did you learn? You didn't learn. You didn't learn. We move on to issues pertaining to simulation analysis. simulation analysis. We talk about issues also pertaining to what? Scenario analysis. Scenario analysis. Right? Very, very important bit to look at. Going through all these bits and pieces will end issues of what? Investment appraiser. Investment appraiser, right? Other important bits to talk about, we're talking about the Ivan-Fisher effect. Ivan-Fisher effect. So basically, what am I trying to talk about over here? We have a relationship between cost of capital and investment appraiser topic. We have two main topics. One topic is called WACC, which every setting tends to come up. And that is what we call cost of capital. Cost of capital is a topic. Investment appraiser is a topic. But there's a relationship between cost of capital, the WACC topic, and investment appraiser. There was a time where I got a student who came to my end for financial management and actually believed that he or she has learned financial management. My quest is not to just show that I know, though I know for sure that I'm doing what is good and is very excellent, but not to show that I know, but to actually let the student know for sure that if we are learning, do not take things on the face value, but to really understand and cement your understanding. Not just a matter of just flipping through the pages. I finished with 20 pages. Then we ask you a question you cannot answer. That is not learning. That's all. So my question was, what is the relationship between cost of capital and investment appraiser topic? And the only answer is to say that cost of capital or WACC will help us determine the discount factor. And the discount factor is what we use in investment appraiser to discount the cash flows. So if you calculate WACC, you are calculating the discount factor. And if you get the discount factor, use that discount factor to discount the cash flows in the case of investment appraiser. So you should know how one topic relates with another topic. And that is basically what I'll also do if I tend to move from one topic to another. So under cost of capital, we'll be looking at issues by Ivan-Fisher effect, right? We'll be looking at Ivan-Fisher. We'll be looking at issues pertaining to interest rate parity theory. We'll be looking at issues pertaining to purchasing power parity theory. We'll be looking at all these bits and pieces. Sorry for bombarding you at the moment. We'll be looking at our good friend, M&M, Modigliani and Miller propositions. Modigliani and Miller proposition were tax without tax in those days. We talk about that. Tax deductibility or the tax shield. And that's why M&M says that every company is supposed to go for debt. But the increased risks of bankruptcy do not actually allow companies to solely finance itself by debt. We're looking at all those of nitty-gritty theories in the case of Modigliani and Miller proposition, where they came up in 1958, and later on Miller came up in 1963. We look at all those issues because it's important in learning cost of capital, which is also what WACC. So we will now look at the numerous ways of calculating WACC, right? So which we know for sure that WACC is cost of equity times the market value of equity. Then we divide this, right? We divide this bit over here by E plus D, right? E plus D. Then we come up to the next bit. So we just say plus, we look at cost of debt. So cost of debt, sorry if it is the first time we are seeing this bit, right? So cost of debt times debt. Then we also divide this exactly, just like what we dealt it over there. So we also say E plus D, E plus D. So this is the formula to calculating WACC. But we have elements in the formula. For example, we have KE. This KE, what are the numerous ways of calculating KE? Cost of equity. What are the numerous ways? So we need to master all these bits as early as possible. I'm never going to do this at the latter point. Never. I'm not going to do that. Right? Good. How do we determine the market value of equity? What are the numerous ways of determining market value of equity? Market value of debt. How do you determine that? Cost of debt. Your examiner mostly tends to worry you by the use of the internal rate of return technique in the valuation of cost of debt, right? So you can see that Modigliani and Miller propositions will make the cost of debt to be what? Tax deductible. So you see 1 minus what? T. We look at what the theories in that regard, right? Good. So when you talk about WACC, the formula in calculating WACC, you should know that bit. There are instances where you tend to chipping issues of preference what debts. The instances where you tend to chip in preference debt. But when you talk about preference debts, we have two types of preference debts. We have redeemable preference debt, which tends to act just like debt. Then we have the irredeemable preference shares, which tends to act like equity. Right. So basically, we also look at what bits in the case of cost of capital. The remaining issues about the financial management paper are theoretical bits, and I will walk you through as easy as I can. Now, what I am going to do with you from now on is to give you an introductory phase of the meeting. Now, the introductory phase, I'm going to explain to you some few bits in the case of financial management. Thereafter, I'll share with you a document which is scanned. And if I share with you that document, please, before I'll meet you again, ensure to write that sort of notes in your either exercise book or whatever. Then when I meet you, I explain to you. If I'm able to do that, what I'm going to do is that I will look at the next topic. The next topic is also very good, very theoretical. I'll look at it quickly, then at least you proceed. The beauty about our meeting is that I have already solved some questions with some students pertaining to those who sat for the last certain exams. So I will share those ones with you when we get to the revision phase, because you're going to finish with the textbook phase as early as possible. Then we get approximately 2 months to solve our past questions. So as you tend to go through those questions which are already recorded, it will give me the opportunity to also record other questions that we couldn't record last time. So I'm looking at solving all questions in the past paper to the effect that we have now solved all questions which are past papers. Now, what you have to do is that by going through them, I all the time come out with this what advice. Do not lie in your sofa. They intend to go through the recorded lectures. You have to sit beside your table and be very active. Every sort of what attention that you can give to yourself, you have to. Sometimes you pause the video, probably I came out with a sentence which you didn't get it right. You can pause the video, listen to it again. That sort of pause, write something in your exercise book, reflect over and over again. These are the sort of ways that we tend to use what online recorded lectures. So, ladies and gentlemen, at this point in time, I am going to end in the case of walking you through, right? If it was to be audit, we just say that this is a walkthrough. So I decided to walk you through the issues pertaining to whatever we look at. But these are just the nitty-gritties, and this is just the beginning. We are more than ready to do the abnormal, as I've indicated during my times of studying the professional qualification. I all the time wanted a tutor who is going to do the abnormal bits. And if I see you are ready to do the abnormal bits, that means that you are somebody who I can study with and I can pass my exams. If you are not ready to do the abnormal bits, I do not think I can fly with you, because I want to also do the abnormal. I want somebody who is ready to also do the abnormal, right? Students tend to do a lot of abnormal bits by waking up at dawn, 2 a.m., 3 a.m., whilst your colleagues are asleep. You wake up, it's an abnormal sort of, right? And you're doing that to actually ensure that you come out with that sort of flying colors. So if you have any questions, any bit of recommendation, you can come up with it. I'm cool. Do not actually hide anything from me. If I walk you through bits and you have a question, do not hide. Do not bring in any sort of sentiment of I'm feeling shy or any sort of. I do not consider that. I do not consider those bits. It will be better. I understand that you have an issue. I'll probably help you backstage so that at least we all be at parity, rather than for you to hide, bring in sentiment. No. We are not looking at that. The most important bit is to help you pass the paper, and that is it. That is okay. So if it happens that some of you are still confused with the timing, I've indicated that with the financial management, we still meet on Tuesday. We meet in the case of Sunday, right? But in the case of financial reporting, the case of Saturday, the case of Wednesday. So tomorrow, Wednesday, is going to be a meeting for financial reporting. I think that I've already introduced you to the bit in the case of that is the introductory phase of financial reporting. And that's tomorrow. I am not going to look at introduction. I'm going to look at the first topic in financial reporting. There is no time to waste. If you have friends who are interested, please, it's very, very important. We are coming out with quality service, and it's important that we also get value for money, right? So we have to get value for our services. So if you can link up with friends for them to also join, for us to get some cash in our pocket, it's very, very important because we are ready to do the abnormal to help in every regard. Let us hear, just like last sitting, that, oh, the issues came up and we are going to pass the exams, students smiling, that sort of whilst others are crying because we started early, we dealt with a lot of good job, and we are still going to smile. And we are smiling because everything we dealt with was by plan. Any question, any recommendation or recommendations? If there is none, the ladies and gentlemen, permit me to bring the on end. Yes, please.
Please, about the timetable, can you please come again with them?
Right. What I'll do is that I'll share with you on the platform again. I think one of you requested for that. So I'll share with you on the platform again so that at least it will benefit others in that regard. Right. So thank you very much. I'm going to do that now.
Last one.
Yes, please.
Please, will there be any PSA class during this session? Sorry.
Please, can you become clear? Just feel free and ask your question, please. Do not hide. Just come boom with your question. I want to hear from you, please.
Will there be any PSA class?
It depends. You see, that sort of section that I tend to start as early as possible, right? I tend to look at it based on demand. So at the moment, I have just 2 students who are ready to hook themselves up with issues pertaining to other papers like PSA, those sort of issues, financial, let me just say, financial reporting. I have a lot of students. I have issues pertaining to audit and assurance. In fact, a whole lot of students in that category to look at. But in the case of PSA, just 2 on board, and I'm just willing to see if I can get other people in that regard. Because at the moment, it's good for you to look at the blend of all the others and see how best things can be. But that is based on demand. That is based on demand. I cannot promise you because the decision of doing it or not doing it is not from my end. It's based on the individuals coming on board. But thereafter, after everything is fine, and the students, those who tends to come up after release of any sort of results and that bit, you know for sure a lot of students tend to come up. And a lot of students are just calling and just asking those sort of questions of, are we getting another session? Are we getting another session? So if it happens that it doesn't feature as early as possible, then you have to wait for when the main group tends to come on board. But I'm just optimistic that there's going to be a provision to that effect. All right, any questions, any recommendations? If there is none, then have a very good evening and hoping to see you coming Sunday again for financial management. I will share with you the document in the case of the note for you to write as early as possible, right? Even if I'm going to be late, my lateness maximum by tomorrow same time, I should be able to share with you because tomorrow I'll have a class for financial reporting. So I'll be talking about accounting standard, those sort of issues. So I think that before I will start that class, it's just a class mode. So to recall, it will help me remind myself that that sort of issues is there for me to send. I have your matters at heart, so do not worry. I will never forget that. All right. Thank you very much for your time and hoping to see you coming Sunday as usual. It is your tutor here, Breman, and as usual, you can call me by 0243-583352 or WhatsApp on that regard. Or you can also email me in the case of any document you want me to share or look at it for you. because of any question you solved or any sort of, you can email that to me by brumanhenry1@gmail.com. Have a very good evening and bye-bye to you.
Thank you, sir.
Send it.